Well, Sunil Singhania is now joining us, founder at Abakkus. Needs absolutely no introduction to our viewers, regular or otherwise. Sunil, great to have you with us here in the studios. Thank you for making the trek. How are things looking, Sunil, especially from an earnings standpoint? What's your assessment of Q1 so far and what this would mean for earnings for the full year?
So I think Q1 earnings so far has been pretty good. Obviously, there have been equal number of upgrades as downgrades, but I think overall, if you see the earnings trajectory has been pretty robust. Obviously, sectors like banking, which were expected to do well, have done well. In fact, done better than what was expected. And one good thing is that the capital goods / infrastructure side of the segment have also done very, very well. In fact, some of the sectors like steel and cement, though not on the margin front, but at least on the demand front and the volume front, have done exceedingly well. There are some sectors which were expected to do not as well. Some of them have not done.
I mean, chemicals.
Chemicals very clearly. And I think it's a function of obviously margins shooting up in 21-22, and then we extrapolating those margins to continue. And second, obviously, there's been a demand slowdown as well as China opening up has also led to higher supply. So I think, but overall, if you see, except the consumption pack, which maybe the demand has got deferred to the second half of the year for a multiple of reasons, I think generally, earnings have been pretty robust.
Okay. Prashant, I thought you were going to start by asking him whether he got spared the traffic today, because and the trek is correct, right? I mean, you do Goregaon to Bali.
Yeah. So today I left early, that's why. Otherwise, it's crazy.
Okay, but I mean, for the market, it's been a crazy ride, right? Almost at 20,000. Of course, a little bit of niggling worry here and there. How do you generate alpha in this market now? Where do you see pockets of leadership coming from?
So one is obviously, in this kind of a market, it's challenging. Not only in terms of finding value, but also in terms of execution. And I think the second part is more challenging than the first part. There's so much interest in the market. The moment, there is even an inkling that someone is interested in a particular company or a stock, the stock just flies off the shelf. At the same time, I think what is needed, obviously, is a little bit of patience and discipline. That's the virtue. These kind of markets suck you in. I always say this, that, in a trending up market, the time taken to research stocks reduces and the size increases, and vice versa. In a trending down market, you tend to do much more research and the size you put in is small. But I think with experience, you learn that you're okay if you miss a couple of stocks here and there, as long as you maintain your discipline. India is a country of entrepreneurs. India is a country of so many listed companies. You'll get something now and then.
Well, Sunil, good to see you and good to have you in the studio. Since you briefly mentioned cement as well as steel, I'm going to focus on the cement aspect. I think many years ago, you were quite bullish on the small cement company that just got sold. And I think in your earlier avatar, you were one of the first few in there. How do you see this space shaping up? Because one school of thought is the smaller guys will get acquired by the larger guys. The other school of thought is things could get difficult now. You have a couple of aggressive large players in there, building capacity big time. So oversupply could actually hurt the industry. Your take.
No, so 2-3 things. One is obviously right now the demand and supply is pretty much matched. Yes, there is capacity coming up. But you have to understand one thing, Nigel, that on a 400 million ton of installed capacity and approximately 350 million tons of demand, even a 10% increase in demand is like setting up 3 million ton cement plants. The challenge has been that last 3-4 years, the demand has not been as robust. And therefore, even some incremental supply causes a little bit of imbalance, particularly region-wise. Some regions there is a huge demand-supply mismatch in terms of more supply, particularly on the southern side. But, if you are banking on the infrastructure spending happening, which we are already seeing, then this growth of 8-9% in terms of demand annually means that, in 3 years, you need like 120-30 million tons of cement capacity, which is not going to be very easy. Because, you have land issues, limestone issues, and I think the recent acquisition is very clear. The motivation was the huge limestone reserves which were there.
Sure.
So I think there's a good sector, but it's not an easy sector. I think the ROEs have historically been pretty low.
Yeah.
And from our perspective, we are very ROCE focused. So that's why, our exposure to cement is very limited to a few companies where there is ROCE. But I think you are right that there are 2-3 now big groups or big, buckets, like you have Ultratech on one side, you have, Adani Group on the other side, and then you have 3-4 like Dalmia and Shree and all, trying to catch up with 30, 40, 50 million tons of capacity. It is in the interim, maybe what you're saying might be right, but ultimately consolidation always helps.
Yes, it's good
so
for
instead of having like 5 million ton cement capacities, if you have 3 or 4 100 million ton capacity, it definitely consolidates and makes the industry much more stabler.
Sunil, just a couple of themes, and I want to narrow it down. So let's talk about areas where there is long runway of growth. Near term, maybe valuations are high. EMS is one area which gets highlighted. The laptop, tablet bit, I think, yesterday. What's your view? Do you own any names, and if yes, why, and if not, why?
So we used to own, we sold off because we found it a little expensive. I think the space is very interesting and very exciting. However, we're always of the view that exciting space does not necessarily mean exciting stocks and vice versa. So the space is good. The margins are very narrow, 3%, 4% narrow. And it's not, entirely sort of having a moat in terms of, entry restrictions. I am sure that in India you'll have 50, 100 companies coming up. Obviously, the larger ones would be in a class apart, but there will be too many of the smaller or the mid-sized ones. And as and when they start to come into the IPO market, this whole, I would say, the premium for which is there because of scarcity might go away. The space is exciting, absolutely no doubt about it, but I don't think they will make more than 2-3% margin going forward.
One more theme. It's a very small area, but I found it fascinating, but never spent the time to understand it. You own a company that's been water purification. I think you have shareholders in Iron Exchange, right? What's the runway for growth there? Because there are not many listed companies in that space as well.
So there is, again, a lot of exciting things happening. One is obviously even on the I would say the manufacturing side, nowadays environment has become very, very important. So this zero discharge has become now compulsory. So that is one part of it. Second is the whole government mission of providing drinking water to everyone. Third is obviously sewage treatment, that you can't just let sewage go into the seas and the oceans, which used to be the case. You have to now treat it. So I think across the board, there is a huge opportunity. And the bigger opportunity is obviously government-sponsored programs. So when you look at every state, I think they have budgets which are like funded by the ADBs and the World Banks and so on and so forth. And on the other hand, you have the private sector capex picking up. So you will have opportunity there also. I think it's an interesting space.
And valuations are okay?
See, valuation depends on what your growth estimates are. So the only company which is listed, I think it's not as cheap as it used to be, but it is still comparatively, compared to all the other capex and compared to the growth, it's still pretty attractive.
Okay, by the way, don't lose sight of the market, which is also looking very attractive at the moment. Over 100 points higher now, and Zomato is clearly the stock of the day, stock of the moment at least, 12% higher. Sunil, I want to ask you about these platform companies, but before that, one space that you've been investing in is this consumer durable space, and Polycab has been one of your top holdings in your all-cap PMS portfolio. Stellar numbers coming through this quarter, but also the stock has rallied quite a bit. You think the best of the gains are behind us in names like Polycab, or is there more to go?
So, if you actually see, Sonia, what has happened in this market is obviously there are more, I would say, investors eager to put in more money than earlier. And the other thing is wherever there is earnings stability and earnings growth, and particularly surprise on the upside as far as earnings delivery is concerned, I think markets have rewarded disproportionately, and I think that has also been the case. The other thing, there is always a case where the market leader and the second company in that space, the valuation gap was pretty large. I think in the case of the company you mentioned, I think they have delivered results which are better than the market leader, and even now there's a discount compared to the market leader in terms of the valuation. So maybe there is a switch from one to the other. Having said that, I think this building material and consumer companies are our way of playing the demand for housing.
Realistically.
As also, the fact that I think India is also moving from only a need-based economy to a want-based economy. Yeah. So we always say that right now 1/3 population is in that want kind of, income bracket. 2/3 is still in that need thing. And this will change to 2/3, which will have some want in terms of their income allowing them to be and only 1/3.
I know the younger generation definitely has moved completely to a want-based economy.
No, but the income levels are also supporting it. No?
So does that support the argument for names like Zomato as well? I mean, profitable for the first time. Do you think there's more scope for these?
So I adore all these platform companies for what they have created in terms of, making our lives easy. We never have thought that we could order from any restaurant at the click of a button. Our only thing is that we are a little bit very clear in terms of what we invest in. So we are very value conscious as well as we are very number focused, and we don't invest in companies where the return on capital employed is at least visibly less than 14-15%. And therefore we as investors don't invest, but I am very sure that these are great platforms, great moats, very difficult businesses for anyone to enter. And as you rightly said, we are now, it's like a way of life for us. It's not something which is like one-off. It's like on a daily basis we order, so and it's only going to increase.
So you'll be a user, but you won't be an investor.
Yeah, because of our own philosophy.
Right. Sunil, final couple of questions before we let you go. I think on IT, the last time you joined us, you were making this point that maybe it could be a decent compounder from here on. Given all the news, do you think IT still is pretty okay? And what about the pharma index? It's coming out of a multi-year, consolidation phase or an underperformance stage.
Right.
How are you all approaching the pharma space?
So IT first, I think IT is one sector where India has global leadership in terms of whatever they do in terms of competency and so on and so forth. And I think that will continue. IT goes through these cycles where there is always in 4-5 years something which is a threat to their sort of business model, And I think now you have this AI and all those related threats. Also, it has coincided with the world economy not being as robust. So maybe in terms of numbers, you might have a quarter or two more before they start to go back to the double-digit kind of a thing. But I think this is one sector where, a 10-12% dollar growth looks possible. The only one thing is that you always had this tailwind of 3-4% rupee depreciation every year. Yeah. I think we are now possibly of a view that this 3-4% might become 1-2% dollar depreciation. And to that extent, your rupee growth, instead of 15-16%, might come down to 13-14%. But given the fact that the companies distribute everything they make, they're very clean companies, I think they will be at least nifty or nifty plus compounders. Pharma goes through mid-cycle sort of, I would say 3-4 year cycles. So you had a great pharma sector move during COVID, and then you had everything sort of reversing because we had more medicines than what we needed stocked up. Demand went down, and then you also had a price correction. Yeah. I think after a long time, we were seeing pharma and large companies available at sub-20 P multiples. So our view is that pharma as a sector, maybe particularly the domestic side, is better than the consumption side. Because there the penetration is already there. In pharma, the penetration is only increasing, the affordability is also increasing. Similar quality of companies, and the P multiples were like 1/3 of what the staple FMCG companies were trading at.
So pharma, domestic, not the US generic.
Domestic companies is much more sort of visible.
Predictable in that sense.
On the export side, there are lots of ifs and buts and company-specific issues, US FDA, which molecule, and so on and so forth. So if you see the 3-4 large companies which have done well in this quarter has been because of one drug, which all of them have got approval for. Right. Yeah. So those kind of things will happen, which will be more company-to-company specific rather than for the whole sector.
Tell us more, Sunil. What do you like? I mean, themes, sub-themes. Infra, capital goods is a area which is picking up. We had SKF India, for example, with us, the management. They said the last capex cycle ended in 2008. His words, not mine. He said, we've been waiting for 15 years, and now finally it looks like we are seeing it. Announcements and spends. So, and they'll see it, right? Bearings are used pretty much everywhere. So,
after a long time, you're seeing everything working well for India.
Right.
Obviously, the only difference is that the valuations have been also working well. It's not as cheap. But on the capex side, if you just look at corporate India, right. So normally 80% of the corporate India's net profit gets reinvested in terms of fresh capacity creation. I think that fell to 45% last 2 years because post the COVID situation, post Russia-Ukraine issue, even the companies were not very sure, so they held back their capex. I think now they have enough gunpowder, because what they did was they were not spending on capex, so that went away in paring down debt. So balance sheets are great. There is demand. There is this China plus one, maybe Europe plus one also playing in, because
capacity utilization is also nearing highs. I mean, 75,
yeah,
80%.
it will be, because last 2-3 years capacity has not been created, and it is also, as I said, coinciding with some export opportunities coming up. Banks have decent balance sheets, so they are in a position to lend. So I think everything has come back in a good way, and government is spending a lot of money on infrastructure. You know, when have you last heard about one single order of 25,000 crores or 50,000 crores coming from government India to one or two companies? So I think it's all working out well.
What's the best way to play it?
No, so I think there are quite a good number of engineering companies, obviously EPC companies also. EPC, because it's not as straightforward to analyze as maybe a cap good companies, you have it. The only problem
I think
is
you guys had holdings in Jaykumar.
We have holding in a lot of companies, but what I'm just trying to say is that just because a company is in defense, or a company is in railways, or a company in engineering, you just can't buy irrespective of the valuation, because ultimately buying a company is like becoming a partner, and you would like to become a partner in a company where valuations also are in your favor.
Correct.
So I think at any point of time, if you are able to get a correction, I think we should have our sort of list ready. Yeah.
Okay, I'm sure people are making their shopping basket ready with your help. Thanks a lot, Sunil, for joining us, and thanks for joining us here in the studio. Really appreciate you taking the time out.